Okay, we're going to get into tonight now, really getting into the details of putting the auction market worldview, putting the tools that we use into this auction market worldview. And the good news is that there are really only two tools. There's the profile graph and there's a bar chart. Now, I'll get into volume at another point in time, but the profile graph is a dimensional view of volume. It's volume on the horizontal scale. A bar chart has volume on the vertical scale, and we will cover those things. So the profile graph is basically a bar chart, but the vertical range of each bar is denoted by a letter. Profile charts have some chronological standard. They can be 5 minutes, 30, daily, weekly, monthly, yearly, just as a bar chart will. Profile charts were specifically designed to provide a view of trade activity on the horizontal scale. It is an ingenious way of replicating volume. And basically what it replicated and what it still replicates in the manner that we use it is transaction activity. It's a transaction at a point in time. And the legacy, the time at which the market profile concept was posited, it's important to understand that because it was posited based on what was available at that time, and even more importantly, what was not available at that time. And that's why it's some of these legacy concepts, if they're sort of, the terminology is sort of head scratching, a lot of it made more sense back in the day when you didn't have real-time volume, and there was a whole vocabulary that built up around the market profile graph that was sort of a legacy. In the profile graph, its genesis was from the floor and the floor activity. And remember, to remind you, the floor, when the market profile concept was first posited by Peter Stellmeyer, the floor ruled the world. In terms of the markets, everything went through the floor. The floor traders had a tremendous edge, not just not having to pay the bid-ask spread, which itself is a huge edge, believe me, but they were the first to see the order flow coming into the pit, who it was from, what they were doing, how much they were doing it, and the floor had that information before anyone else. You were at a tremendous disadvantage, and you, as an off-floor trader, a tremendous disadvantage. You really didn't know what was going on until it was too late to act on it in anything resembling a short-term time frame. Now, the irony is that now the floor is sort of a relic. Some of the New York markets still have an active floor with a lot of flow through there, but the Chicago markets, I don't know about the grains, but certainly the S&P, it's for show now, for all intents and purposes. There is so much trading that goes around the floor and into the mini and electronically, even in the big contract, that the floor is as reactive now as an off-floor trader, and in sometimes even more so. So the information flow has dramatically shifted away from the floor having this huge advantage to, quite frankly, the off-floor trader having a bigger advantage. Sadly, the biggest advantage an off-floor trader has is missed on most off-floor traders, and that is the ability to sit there and do nothing. Most of the time, what you should be doing as a screen-based trader is nothing. Even if you are a day trader, most of the time, what you should be doing is nothing. You're either out of it, you're not in a trade, and you're looking for the opportunity that's defined, and we're going to define that tonight. Or you're in a trade, and you're waiting to either get stopped out or have your target hit. And, I'm oversimplifying that a little bit. You can, there are, you do want to, you have the opportunity to manage your trade once you're in it, even if it doesn't stop you out and it hasn't hit your target yet. There are things that are advisable to do when you're in a trade. But most of the time, as an off-floor trader, screen-based trader, what you should be doing is nothing. Okay, I'm not going to get into a lot of the detail minutia of the profile graph, except to cover the basics. These letters are TPOs, and what TPO stood for, according to Stottlemyre, time, price, opportunity. And this is typical Stottlemyre, coming up with sort of a head-scratching, abstruse definition of something that's relatively simple. Leave it to Don Jones, who, again, he's a physicist. He's literally a scientist. To simplify things, that price occurred. So I really prefer that price occurred because that's what it is. This indicates that a price occurred at this level in this time frame. Now, understand that in a 30-minute profile, each rotation, each vertical bar, each slot is 30 minutes. You will only have one print in that 30-minute period, no matter how many times price passes above and below that particular price or prints at that price. Now, each of these vertical lines can be, it's a bar chart. You can have a 30-minute chart, you can have 30-minute, you can have 60-minute, 5-minute, daily, weekly, monthly, etc. So the chronological protocols can change, and you see me frequently change views to get a view of the auction. And that all I'm interested in the profile graph is getting the best view of the auction at this point in time. You'll see me use weekly, daily, monthly. You'll see me take parts of days and combine them into the previous day. And I'll show you a little tip on what I'm doing and how I'm doing it. There's no big mystery to it. There's no one hard and fast rule. There's a very, very simple technique that you can use. But it all gets, it all revolves around understanding what the auction process is doing. The auction process is referring to value. What is the market doing in terms of value? Is it accepting value here, or is the condition of value at this point in time changing? Those are the questions you're always asking, and that's what the profile graph was designed to do. It wasn't designed as a trading tool, some sort of rote, if it trades 3 ticks into the value area, you sell it and all this nonsense. That's not how it was designed, or what it was designed for. The profile graph was, I still don't think it's appreciated how it was really a complete paradigm shift. Actually, that paradigm shift is, I'm still waiting for it to kick in. And that's the good news for you guys yet. People still don't get it. People still do not get what, the real incredible value of the worldview of auction market concepts. They're still trading the profile graph. But if you go back and you really, really read Stottlemyre's work and his early stuff, and even now, and sort of read between the lines, he's talking about an auction and he's talking about a development process. And his desire was to get people to understand that they had to be trading a market condition, and that market condition was tradable information. It could be traded different ways, but not only was it tradable information, it was ultimately a necessity to trade successfully to understand market condition and what a market was doing. Okay, this is the S&P chart. Now, this is a yearly chart. In other words, each one of these auctions, each one of these profile units is 1 year of trading. Now, there are a couple of things, subtle things to note here. An auction is not always this nice, neat Gaussian shape where we have, you know, three clear, you know, you have a third standard deviation up here, third standard deviation down here, and then your high volume node is at the mode of the distribution. So it has the general shape of your typical the bell curve of a typical standard distribution, but you're missing the point if that's what you're assuming is always going to occur. Not only are you missing the point, but you will be thoroughly confused and even worse, lose a lot of money if you're assuming that all auctions are going to end up in this nice Gaussian shape. They're not going to. You can see somewhat the regressive nature of price, and it's the regressive nature in price in a given time frame that creates this bell shape where you have basically unfair highs, unfair lows in an area of greatest value. The key point to the fact that you have that price is regressive is that it's regressive around value. But value is a moving target. Value changes. So if you're sitting there assuming this is always going to be value, you're going to lose a lot of money. You have to be, that's why you've got to understand the concept of value and the migration of value, and when value is transitioning, when the present perception of value begins to change, you have to recognize that and change with it. All right, here's quarterly. I'm just going down in time frames, and this is an exercise to show you, to continue to reinforce the idea of what a remarkably robust methodology this is across all time frames and all markets. So each one of these is a quarter. Each individual letter, each slot is a week. And then here we have individual months where each letter is a day. And this again is the S&P. And this is live cattle. So what does the S&P and live cattle have in common? They're both traded in an auction market. Therefore, you can trade live cattle and the S&P Mini on a 5-minute chart exactly the same way. Now, I don't suggest you trade live cattle on a 5-minute chart, but you can certainly trade live cattle on a 30-minute chart, and at times you can actually find 5-minute setups in things like live cattle and lean hogs and things like that. We've done this, and we'll do it in the room periodically. The grains were an example. I could take all night. I could walk you through every single market that I have access to and show you these auctions that are all the same shape. And the reason they're the same shape is because the auction process is the same regardless of the asset or regardless of the time frame. So the highest use of the profile graph is clarity into what's going on within the auction. And it's, the profile graph should not be used as some sort of magical tool that you rote trade. If the market trades up here, I'm definitely, I'm doing this or that or the other, whatever. But it is, once you do understand the auction process, it can be an incredibly powerful tool in getting the read on that market condition. Is market condition about to change, or is it the same? And the other thing that is unique about auction market concepts and market profile is the terminology we use. And I try to be very careful about the terminology that I use, because I think it's important. You don't want to develop a mindset that prices below are always support, and I'm only buying if prices reach if prices go down here, I'm only going to buy. I'm not going to look at anything else or consider the fact that maybe if it gets down there, I might need to sell. That's a price-based approach to trading. That's why I use the term inflection points and key reference areas rather than support or resistance. Now, the reality is that you make a certain assumption, a bullish assumption, for instance, like today in the indices, and so under that assumption, under the bullish assumption, this logically you were sort of leaning that this should be support under a bullish assumption. But if we started to accelerate lower, you had to adjust pretty quickly. So, and I think you can go back through this and you can see the levels that have held consistently under a bullish assumption, these that are inflection points. The market moves sharply away from these inflection points consistently. So it's not just, there is an edge in trading from certain areas. If I often use the example, if you would trade in certain trade location, you could actually flip a coin as to whether you went long or short, and over a large sample of trades, you'd have a positive expectancy. Well, you can do better than that by having a more complete view of the auction process prior to that market in the smaller time frame that you're trading, what's going on in the larger degree time frame. So that helps you make a logical assumption about the probabilities off of that level.